大家早上好，今天我想利用这个时间来给大家讲讲一些普通的宏观经济的知识，也讲一下，如果你们自己是投资者的，那么对于今天现在马上要发生的美联储要降息这个事情，有一些什么样的考量今天我会简单的讲一讲因为有很多东西是比较学术性的，所以我可能还是要用英文来讲有一些地方啊。那如果没有听过我讲课的朋友我叫达安娜，我姓杨，那早年呢，好多年前来美国念的 MBA，在那个 NIU，那么也做过很多各种各样的就是审计税务方面的工作，在大的财务公司那么我自己现在是financial advisor，自己有自己的就是 consulting business，从事于就是帮助客人就是解决税务上面优化，怎么去做投资省税这些计划等等设计师。那么下面呢，我就给大家讲一些就是有关宏观经济的东西那很多朋友呢，他们对自己的投资很想自己去做一点事情，不管你是买房子也好，或者是放个 CD 也好，或者是放一些股票资金甚至是买一些 bond 债券之类的。那么对于整个宏观经济来说呢，我们多少要有一点认识那就是说，对有一些知识来说呢，对于就是市场上面的一波动或者是你从新闻上面看到一些什么样的消息你就会很自然的就会用到这些知识好，我们今天先讲一下，就是什么叫做 business cycle 我可能要转成英文了，因为 business cycle is basically you have peak and throw. What is peak? So business cycle normally, if nothing major happen, it lasts about 10 years. So every 10 years, you will have a very peak performance of the economy and also some low points. Right? If you have continuously 3 quarters of low points, you are entered into recession. Okay, recession is not a cycle. Expansion and contraction is a cycle. So you go from low to high, we call it expansion. From high to low, we call it contraction. What is indicated as a contraction and an expansion? Let's take a look at expansion. If you GDP, I'm going to talk about GDP later, okay? Gross domestic product. This is actually it's the indicator is whether the economy is growing or it's just keeping it flow or it's actually going down. Okay, so in the early stage, let's look at the cycle. You are from the economy is recovering, so everything is going up. So you can see employment is another indicator. Employment is going up, GDP is going up, and credits is going to grow. That means bank is more willing to lend you money, and the company's profit is going up. So in policy, government is policy. I'm going to talk about government policy, how they control the market and manipulate the market. So later on, it's going to be talk a little bit about the government policy. Government's policy is stimulating. It's easy money policies. So it will move the economy from low point to high point. So when you go into the middle of this expansion, you can see things start getting a little bit slow than the early stage. Profit is still growing because it hasn't reached the peak yet. And government policy is turning from loose, easy money to neutral. Okay, and inventory and sales still growing, but you can probably reach equivalent. What does that mean? Is, you know, inventory and sales probably you don't have over, you know, low in the inventory like you are in the early stage, but your inventory, it's in the sales, it's probably breaking even. And in the later stage, you can see the growth is losing its steam and it's going, everything is slowing down after they pass the peak. And in the next stage, you can see the economy is going through contraction. You can see it in this cycle, right? So there are two indicators to determine your economy is in the peak or in the thaw, or is in somewhere in between. It's in contraction or in expansion. So the indicator, the number one indicator is GDP. And number two is employment, right? Employment is a little bit late, published by the government statistic. It's usually a couple months late. So, you know, when you read the employment data, so just be sure you understand there will be a time difference for the employment data when you try to interpret that. Okay, so the GDP is what is for the there are four portions of GDP that will increase the GDP, right? So number one is personal consumption expenditure. So including, you know, everything you buy, like consumer spending, like buying a car, buying furniture, large compliance, clothing, food, fuels, you know, those things, right? So, and the second part of that is very huge part is business investment. Now, business is seeing the economy is growing and they want to grow the business, and they're more willing to invest in their business expansion. So you can see the investment from the business, and at the same time, when in a expanding economy, and it's probably the government, you know, the interest rate is relatively lower, and the business is more easy to borrow money to invest, so they're more willing to spend investment in their capital to expand the business. And the other part is that is government spending. Okay, government is increase the spending, like building more infrastructure, building more highways or highway improvement. Let's say in doing more of the invest more in the airport, and you know these are government spending, right? Defense, and these are all government spending. So when you see government spending is actually one of these big chart part of the GDP. Okay, import and export. Export is favor our GDP. Why? Because export is made in the USA, right? So whatever you make in the USA and you ship it to other country, that is called export. So the production is in the US, and that will increase our GDP, you know. In the other way, if you import goods, that means these products were produced in outside the US. So it won't count as our GDP. But in another sense, it will net against our export and become part of the GDP. So import is a negative GDP. That's why, you know, when moving all the manufacturing companies saying, you know, moving back to the US, why is that important? Because whatever makes in the US will be increasing our GDP, will increase government revenue in taxation. That counts positively to our GDP. So it helps the economy to grow. Okay, how do government control the economy? Okay, there are two. This one is major, right? Fiscal policy. Fiscal policy is actually it was a fiscal policy was made by the Congress, and it due to interfere the markets when the economy is not in a good time or in a bad time. Okay, so let's say the economy, how Congress through fiscal policy to influence the market. Number one is through government spending. Number two is through taxation. Okay, collecting tax. Okay, so let's say if there's a high employment and we are in a contraction. So GDP is coming down. We are going through the lower point of our business cycle. So what the government do? So government at the same time, they will probably have some policy coming out. Maybe we'll reduce some of the tax. Okay. So, or maybe we increase government spending. So pump more money into the market. Okay. Or they buy more bonds, government bonds back, so they can release some money into the system to stimulate the economy. Another major market influencer is the central bank. Okay, we call the Fed, the Federal Reserve, right? So we call the Fed. Okay, Fed is actually not a government body; it's a private entity, but it's a the Federal Reserve Bank's the Federal Reserve Bank's chairman was appointed by the Congress. Okay, so let's talk about a monetary policy. So this is the Federal Bank, the Federal Reserve Bank actually can control the discount rate, the reserve requirement, and the open market operation. Okay, now we'll talk about that. What is the discount rate? So the discount rate is the rate that the government can lend to the bank. Okay, now this is different than the prime rate. Prime rate is the rate that bank lend to the best customer. That is a prime rate. So discount rate is the government can lend it to the bank. So reserve requirement. Reserve requirement is the requirement that they set for the bank, because when the banks get your money, right, you deposit the money into the bank. So overnight, and before they allocate it to their portfolio or investment or the lending, they have to keep a reserve in the bank. So it's called the override rates, and it's called a reserve. Now that reserve is Fed has to say for the reserve requirement. If I increase the requirement, that means more money keep in the bank and less money lending out. So this money keep in the bank, it becomes a reserve requirement. So this is the one element that central bank is going to is influencing the market, the economy. Okay. Another one is open market activity, including the Fed is selling securities or buying security. Okay, so let's do an example. Let's say if the market is in expansion, everything is employment is good, but inflation is very high. So eventually inflation is high, it's going to hurt the economy, right? So when inflation is high and market is stable, policy is neutral when the inflation is high. That means we are going to possibly, this is low, right? This is low. So what did Fed do? Fed is going to drop the market, Fed is going to increase the market rate. The discount rate is to make you borrow money from the bank and paying high interest. Let's say if they move the discount rate up, they will affect business lending costs because now they have to pay more money to borrow a loan from the bank. So their market expansion, their production expansion is going to contract, right? And consumer side, if you want to buy a car, you want to buy a house, and you still have to borrow money from the bank because now the rate is high. So you'll probably wait a little bit to buy a house because now your mortgage is more expensive. The interest every month is going to get much higher, right? So the intention of increasing the rate is to calm the economy. So it's overheat now, right? Everything is, inflation mode, right? So, and at the same time, they can increase the market reserve, the bank's reserve requirement, meaning keeping more cash into the bank instead of lending it out, right? Vice versa, if they want to encourage the economy, to release the money into the system, they will drop the rate. So when they drop the rate, meaning your mortgage rate is coming down, your car loan payment is coming down, and much easier for business to borrow money. So at this point, there will be more people willing to buy the car and buy a house, and business is more willing to invest. And at the same time, reduce the bank's reserve requirement, more money will pump into the system. And at the same time, market activity, the Fed will probably, sell more of the stocks, the equity, just to up, get more money into the system. Sorry, the other way, okay, is to buy more stock, right? So get more money into the system. Okay, so I just briefly introduced that how the market work, how to read those GDP and employment number, and how the Federal Reserve Bank, and the government influence the economy. Okay, so I talk a little bit about basic investment concept. So everyone probably already knows what's the Rule 72. This is if you invest and you're looking for return, this is your golden rule, right? So money has to compound, not just straight interest, right? Money grows money. So let's say if you just remember, forget about this. This blue one is a little bit complicated. I will go into it later, but not now. So just take a look at this. 72 divided by a number. Okay. If you take 72 divided by the return equals to number of years, you're going to take double your money. For instance, at age 30, if you put $10,000, $10,000 divided by 4, right? So you got 18. I'm sorry, 72 divided by 4. 72 divided by 4, you got 18. So your money take exactly 18 years to double. Right. Now, if you invested 30 at age 30 at $10,000, by age 48, your money double to $20,000. So if you continue to invest at 4%, by age 66, your money doubled again. So this is called the compounding effect. It's like snowballing, right? So it's very easy. 72 divided by an interest rate. This is your return rate. This is the number equals the number of years that take your money double. Okay. So let's take a look at 8%. Even though I doubled the interest rate, right? I double my return. But 72 divided by 8, I only need 9 years instead of 18 years. That double my money. So if I already starting with 8%, I'm not just like double my money. After 36 years, my pile of money will grow into 160,000, which is 400%, 4 times of somebody who invests in 4%. Okay, this is the power of compounding. This is very important, right? So that's why, a lot of people say, oh, I know I need to put it in a higher interest rate. I need a higher interest rate. Okay. But higher interest rate also comes with higher risk. What is the risk? It's about the risk. There are lots of risks, right? So we're going to talk about risk in the later section. So today I'm just going through some basic. As you see, CDs, treasury bills, these are very low risk and their return is very low too. Compare with stocks. Stocks, a lot of people probably invest stock. Some people invest in option and future. These are very high risk, but potentially you're going to get a higher return. So risks and returns are hand in hand. Higher risk, higher return. Higher return, higher risk. So back to here, if we are just looking at our return and forget about our risk, this is not an investor, right? This is a gambler. Okay, so a lot of people say, oh, if I diverse my portfolio, I put some stock here, some stock there, I will probably control my risk and I diversify my risk. Okay, this is a misconcept. Diversify my risk. What type of risk? Okay, what risk we are talking about? There were 2 types of risks. One type of risk is called systematic, non-diversifiable risk. The other is unsystematic, diversifiable risk. Okay, so systematic risk, we call the prime, P-R-I-M-E here, right? Prime. They are reinvestment risk, they are interest rate risk, marketable risk, market risk, exchange rate risk. These risks you cannot diversify. Purchase power risk, which is inflation, you cannot say, okay, I am putting some stock in Microsoft, some stock in Costco, and I can diversify. Inflation risk, no, you cannot. Interest rate risk, if the interest rate is going up, and everything will, in responding to interest rate, will be either up or down, right? So market risk, you cannot diversify, right? What you can diversify is a business. Everything you knitted to that company, to the business and industry. Because let's say if you put some stocks in Microsoft and Costco, they are totally different business. So you may be able to diversify some risk that comes with like software development. And Microsoft may drop, but Costco is still standing strong. Right? Okay, you can diversify regulatory risk. Like, for instance, pharmaceutical company is highly regulated. They have the higher regulatory risk. But pharmaceutical company, there are lots of good things about pharmaceutical industry that you can invest. But you can invest in a pharmaceutical company and at the same time diversify regulatory risk in some other stocks like Costco, Walmart. Those are much less regulated companies, industry. That is called diversifying risk. Sovereignty risk. You can put some stocks in the US, or you can put some stocks in the Far East, right? And they are totally different society, different system. At that time, when you diversify like that, you diversify some of the risk that comes with what kind of leadership and government in that country or in that region. Okay, so I'll just pick a couple of samples. Okay, now let's take a chart. Okay, this is how they measure the risk. Some of the risk on the upper side is called the unsystematic risk, which you can diversify by adding some of the stocks or portfolios and to reduce these unsystematic risk. But the systematic risk is always there. You won't be able to reduce it. Okay, I'm using standard deviation. So you can reduce unsystematic risk to a point, and no matter what you do and how many more stocks or different types of stock adding to the portfolio, it's going to be there. So it's only good at a certain point. You can diversify. So a lot of people say, okay, I can diversify. So you got to understand what you can diversify and what you cannot. All right. So for instance, now the Fed is going to cut interest rate. So it will affect some of the part of the market, maybe. So what you can do, right? Government is going to increase tax, right? You can't do anything. Increase tax is going to increase tax, all right? So these risks called systematic risks, you cannot diversify. But of course, increased tax, it's very specific for some company, some industry. Let's say they give a huge R&D credits for pharmaceutical company, and that is a different story. Okay, that is a different. It moved from systematic to unsystematic risk. Okay. All right. So I just do a little bit, talk a little bit about the housing market, and Fed is going to increase drop the rates, and definitely, your market is going to be more favorable if you're buying a house, right? When you get a mortgage, it's going to be your borrowing cost is going to be cheaper. So your interest rate, you can see your monthly payment is going to decrease. So a lot of people is waiting for that to buy the house. They have been waiting for probably 3-4 years. Not 3-4 years. I mean, probably the past 2 years or 2-3 years. Okay. But at the same time, housing market is also driven by supply and demand. So how many houses in the market and how many people want to buy the market? If the people who wants to buy the market much more than the inventory in the market, which is the supply side. And then no matter what, the housing price is going to be up because you got more people want to buy houses and there are not that much houses for sales, right? And on the capital market, when the interest rate coming down and the market price is going up. So we can talk a little bit about it in my next class. I just want to see, there's another thing that I want to point out. This is the yield curve, right? So this is also, people who can see, okay, when Federal Reserve Bank is increasing or decreasing the interest rate, what is the market's perspective? Okay, so let's look at the middle. If the Fed is going to increase interest rate and the market response is positive, that means they agree, oh, that is the right move. Government is, increasing the interest rate. It is the right move. So, and then the market by supply and demand, and you will see the curve is moving like that. It's called the upward slope. So this is the good things, right? Government increase the interest rate and the market seems to agree to it. But if the market has no response, we call it flat. Okay, here's the thing. Government wants to increase the interest rate, but the market say, I don't think it's going to last. I think they're doing a bad thing. Just give you a very politics scenario, right? Trump has four candidates for the Federal Reserve Bank. He is favored to the one that advocated reducing interest rate. So, but at the same time, the market doesn't think, don't think that guy is qualified enough, he has enough experience and things like that. So the market is not as optimistic as, when the Fed eventually going to cut the rates, right? So in that one, we call the reverse inverted slope. Inverted slope, that meaning, okay, Fed is doing one thing, but the market respond the other way. Okay, so this slope, when they say the inverted slope or the downward sloping of the yield curve, is basically, an indicator of an economy is going into a recession. So watch for that. Okay, when you see the news, it's, people talking about inverted slope or inverted curve. This is what happened when Fed wants to go this way and the market say, I don't believe they're doing the right thing. I don't believe so. And the supply and demand will reflect on the price of the market yield, right? So Fed's influence is short term, but the market supply and demand, it determines the real return of the market that is long term. Okay. Okay, I think I got enough of this. I was going to talk about bond price. Okay. Probably not going to talk about bond price yet. I'm going to talk about this efficient market. So, what type of investor you are? Are you a active investor or are you a passive investor? So, what is active? What is passive? A lot of people say, I pick my mutual fund. I pick QQQ. I pick index fund and I stay there. And I think it will grow. Okay. So let's talk about this. Okay. So understand what type of investor you are and probably help you to managing your finance. but it is not replaced, advice with from the professional, right? Okay, there was under the market efficiency theory. We also call it market efficiency market theory, efficiency market hypothesis. Okay, some people really believe that they don't need any of these insider information, fundamental analysis, technical analysis. Okay, let's go through that one by one. Okay, what is the insider information? This is some, insider information of the company or the industry, right? Fundamental analysis is analyzing this company's EBITDA and annual reports, and that type of analysis is fundamental analysis. Technical analysis is tracking the pattern of the stock and measuring them, and these are technical analysis, right? There were three forms. One is a weak form sets. These people, they believe in, okay, if I can get more insider information and I do my fundamental analysis, and I got a chance most of the time, hopefully, got a chance to beat the market. Okay. The semi-strong is the one that said, I don't think how much analysis you can do. I don't believe these analysis, but if you know the industry, you have some insider information that will win. And these people will try to seek that. That is called, they are still believing this information can influence their market and the investment decision. So at this point, the semi-strong and the weak, I'm more of an active trader, active analytical investor. These are active investors, right? So there was people who said, doesn't matter how you analyze the market, it doesn't matter how much information you get. It's not some of the things the market ups and down you cannot explain. Right. This is because the market is efficient enough. It really doesn't go with whatever you predict. So these people believe, if I stay in the market, so, in the long run, and the market will win. So these are mostly passive investors. These are the people who pick the QQQ, who pick the index fund and stay there. Okay, so understand more time. Of course, this is just by theory. A lot of people probably in between, right? Or probably more of here or rather than here, even though they are in a strong form set. So understand, what is your investment style? What's your focus? It's probably helped you to understand your style of what sort of a investment you want to go into. Okay, so next I'm going to talk about how to calculate return. This is going to be my next class. I'm running out of time. So again, these are mini-series. It's try to give some information, from all the, from all my regular financial workshops, and I try to help you to understand, what is the market, how they perform, who can influence, and what kind of decision, how to measure return, how to measure risk, in a very simple way, of course, right? So my WeChat here, if you want to connect to me, and always, you can text me. Don't call me because I won't pick up phone call. And I will see you next week.